Imagine you have, diligently saved for 30 years, you finally retire, and you decide to take an extra $5,000 out of your 401k to buy a new couch.
Right, a nice little reward for yourself.
Exactly, but suddenly the IRS confiscates nearly half of it, and your Medicare premiums double. Welcome to the financial minefield of decumulation.
Yeah, the phase where you actually spend your retirement savings is, I mean, it's arguably much more complex than accumulating it in the first place.
Oh, absolutely.
Because one wrong step, and you can trigger this cascade of taxes that fundamentally alters your lifestyle. It just depletes your wealth years faster than you anticipated.
Which is exactly why we are doing this deep dive today. We've got a really fascinating stack of sources in front of us to unpack.
We do. Some heavy hitters in here.
Yeah, we're looking at the official 2025 IRS publication 590B, which is, that dense bureaucratic rule book for IRAs.
Good bedtime reading.
Right. And we have comprehensive wealth management playbooks from advisory firms like Savvy Wealth and HBKS, plus, maybe most surprisingly, some deep behavioral finance research from the IAS Business School and financial planner Michael Kitzes.
It's a great mix. It creates this perfect blend of the strict legal realities of the tax code and the psychological traps we fall into when dealing with our own money.
And our mission today is to help you, the listener, cut through all that dense financial jargon. We want to show you how to strategically organize your money so you don't step on those hidden tax landmines in your golden years.
Because you want your money working smarter, not harder, right?
Exactly. So, okay, let's unpack this. Before we can really talk about dodging taxes, we have to understand how the IRS actually categorizes your money.
Yeah, the rules of the game.
Right. And the overarching foundation of retirement planning relies on understanding the three-bucket strategy.
And just to be perfectly clear up front, right now we're talking about buckets in terms of tax categorization, not necessarily your investment time horizons.
Right. Good distinction.
The IRS basically sorts your retirement savings into three distinct tax buckets, and every single dollar you own falls into one of them.
So bucket number one is the tax-free bucket. This is your Roth IRAs and your Roth 401ks.
The favorites.
Oh, yeah. You already paid income tax on this money before it went into the account. So when you pull it out in retirement, the withdrawals and, all the growth are completely tax-free.
It's essentially the holy grail of retirement accounts.
Then you have bucket number two, which is the tax-deferred bucket. And this is where, the vast majority of people hold the bulk of their wealth.
Right, we're talking about traditional IRAs and standard 401ks here.
Yeah. You received a tax deduction when you put the money in, and it grew tax-free for decades. But the IRS eventually demands their cut.
Oh, they always do. Every dollar you withdraw from this bucket in retirement is treated and taxed as ordinary income.
And you can't just leave it there forever to avoid the tax man either. The government forces you to start taking required minimum distributions, or RMDs, beginning at age 73.
Yeah, they mandate a certain percentage must come out every single year. And that's whether you actually need the money to live on or not.
Which brings us to bucket number three, the taxable bucket. This is your standard after-tax brokerage account.
Now, this bucket often gets a bad rap in casual personal finance circles
It really does.
because it lacks the immediate tax breaks of a 401k or, the tax-free growth of a Roth.
Yeah, I hear people say, why would I want an account where I have to pay taxes on dividends and capital gains every single year? Doesn't that make it a leaky bucket compared to the protective shield of a retirement account?
It's a common concern. But think of that leak as a necessary pressure release valve.
Okay, I like that.
The taxable brokerage bucket is actually the unsung hero of a smart retirement plan. It operates under a completely different set of rules that provide incredible flexibility.
How so?
Well, yes, you pay taxes on dividends as you go, but when you finally withdraw from that brokerage account in retirement, you are only taxed on the gains, not the principal you originally invested.
Right, because you already paid tax on the principal before you invested it.
Exactly. And more importantly, those gains are subject to long-term capital gains tax rates, not ordinary income tax brackets.
Okay, let's translate that into a real-world example to show just how massive that distinction is. Let's look at a $50,000 scenario versus a $100,000 scenario.
Sure. So let's imagine a retiree who needs $100,000 this year to live on.
Okay.
If you pull that entire $100,000 income from your traditional 401k, the IRS stacks every single dollar up and taxes it at ordinary income rates.
So you're getting pushed through the 10%, the 12%, and well into the 22 or 24% brackets.
Exactly. You could easily owe $15,000 or more just in federal income taxes.
Ouch. Okay, so what if we pull that from the brokerage bucket instead?
Contrast that with pulling the same $100,000 from your brokerage account. Let's say you invested $50,000 a decade ago, and it grew to $100,000.
All right, 50,000 basis, 50,000 growth.
Right. When you sell and withdraw that money, that first $50,000, your original principal, is returned to you completely tax-free.
Because it's just your own money coming back to you.
Yes. You only owe taxes on the $50,000 of growth. And because you held the investments for over a year, that growth is taxed at long-term capital gains rates.
Which are significantly lower. I mean, for a typical middle-income earner, the long-term capital gains rate is 15%.
Yep. But it gets better. If your overall taxable income is low enough, that capital gains rate drops to exactly 0%.
Wait, really? 0?
Yes. You could potentially withdraw that entire $100,000 and pay 0 federal income tax. The tax savings between the 401k bucket and the brokerage bucket can literally be tens of thousands of dollars a year.
That is wild. And beyond the tax savings, the brokerage bucket offers total control over your timeline, right?
Absolutely. There are no age 59 and a half early withdrawal penalties. If you want to retire at 50, this bucket is fully accessible.
And no required minimum distributions at age 73 either.
Right. You dictate exactly when and how much you withdraw. You can even use strategies like tax loss harvesting.
Which is where you sell investments that are down to offset the taxes on the ones that are up. Right?
Exactly. It's incredibly flexible.
Here's where it gets really interesting, though. Now that you know what the 3 buckets are, we need to talk about why having money spread across all of them is so critical.
Because if you put all your eggs in that tax-deferred 401k bucket, you are walking straight into a hidden trap.
Yeah, the sources we're looking at call this trap the tax torpedo.
It's a great name for it, honestly. The tax torpedo catches so many retirees completely off guard. It revolves around how the federal government calculates the taxes on your Social Security benefits.
Because most people assume Social Security is automatically tax-free. I mean, I used to think that.
Most people do.
Oh.
But that is rarely the case for anyone with retirement savings.
Right. And to figure out how much of your Social Security is taxable, the IRS uses a formula called provisional income.
Ah, yes. Provisional income.
Now, provisional income sounds like something a Victorian headmaster invented just to punish you for saving money. Like, why does this even exist?
It is a fascinating piece of legislative history, actually. Back in the 1980s and 90s, the government needed to shore up Social Security trust funds.
Okay.
But they knew that officially raising statutory income tax brackets on seniors would be political suicide.
Oh, for sure. You don't mess with senior voters.
Exactly. So they created this provisional income formula as a compromise. It acts as a stealth tax.
A stealth tax? Wow.
Yeah, it was deliberately designed to gradually tax the Social Security benefits of wealthier retirees without ever having to change the headline tax rates.
So how is it calculated?
Provisional income is essentially your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits.
Okay, let's translate that into real money with a concrete example, the couch example from earlier. Let's say you're retired, you're living on a fixed budget, and suddenly your car transmission blows, or you need a new couch.
Something always comes up.
Always. You need an extra $1,000. So you pull $1,000 out of your traditional 401k. The IRS taxes that $1,000.
Right. But that withdrawal also increases your adjusted gross income by $1,000.
Which pushes up your provisional income.
Exactly. And once you hit certain thresholds, that single withdrawal triggers a cascade. Suddenly, an additional $850 of your Social Security benefits is pulled into the taxable column.
Wait, so you only put $1,000 in your pocket to fix your car? But you are now paying income taxes on $1,850.
That is the torpedo in action.
That's insane.
It really is. Research from groups like Retire Inc. shows that for many middle-income households, this double taxation effect causes their marginal tax rate to skyrocket.
So what are we talking here? How high does it go?
A single taxpayer taking moderate Social Security benefits could easily face a federal marginal tax rate of 40.7%.
Over 40%.
Yep. And if the tax brackets revert to pre-2018 levels in 2026, as they are scheduled to do, that marginal rate could hit an astonishing 46.25%.
Nearly half of that next dollar is confiscated by the government. just because you pulled it from a tax-deferred account.
Exactly.
But it actually gets worse, doesn't it? Because there is a secondary trap buried in the rules called IRMA.
Yes, IRMAA. It stands for the Income-Related Monthly Adjustment Amount. This is a surcharge added directly to your Medicare Part B and Part D premiums if your income is deemed too high.
And unlike normal injury taxes where you just pay a little bit more on the very next dollar you earn, IRMAA operates differently.
Vastly differently. It operates as a cliff.
A cliff. So there's no gradual phase-in.
None at all.
Okay.
If the IRS threshold for the first IRMAA surcharge is, say, $103,000 for single filer, and your modified adjusted gross income hits $103,011,
Just $1 over.
just $1, your Medicare premiums for the entire year immediately jump up. That $1 mistake can literally cost you over $1,000 in unexpected surcharges.
I always think of relying solely on a 401k, like setting up a line of dominoes. You take that extra dollar out to buy a new couch.
And that extra dollar knocks over the first domino.
Right. Pushing up your provisional income, which triggers the tax torpedo on your Social Security. That knocks over the next domino, pushing up your modified adjusted gross income, which pushes you off the IRMA cliff, doubling your Medicare premiums.
Suddenly, because of all the cascading taxes, that is a profoundly expensive couch.
To say the least.
And the most insidious part of IRMAA is that it operates on a 2-year lag.
Wait, really? A lag?
Yes. The tax return you file today
Yeah.
dictates the Medicare premiums you will pay 2 years from now.
Oh, wow.
So if you take a massive 401k distribution at age 63 to pay off your mortgage before you retire, you might be entirely shocked to find your Medicare premiums are doubled the moment you turn 65.
Okay, if you are listening to this in your car right now and your head is spinning with provisional income math, IRMAA cliffs, and acronyms, do not panic.
Breathe. It's manageable.
The core takeaway here is not to memorize the tax code. The takeaway is that we need a map to navigate around these landmines. So how do we actually diffuse these traps?
Diffusing the traps comes down to relentlessly controlling your taxable income year by year. The generally accepted sequence for withdrawing your money is to pull from your taxable brokerage bucket first,
Okay.
then your tax-deferred bucket, and save your tax-free Roth bucket for last, allowing it to compound tax-free for as long as humanly possible.
But the sources outline a much more proactive defensive maneuver called the Roth conversion ladder. This is where you voluntarily move money from your traditional IRA into your Roth IRA.
That's right.
Now, if I do that, I have to pay taxes on the money I control today. Why would I volunteer to write a check to the IRS now?
Because you get to dictate the terms. Let's say you retire early at age 60. Your income drops to almost zero because you're not collecting salary and you haven't started Social Security yet.
Right, makes sense.
You're sitting in a very low tax bracket, say the 12% or 22% bracket. You can strategically convert just enough money from your dangerous traditional IRA to your safe Roth IRA to completely fill up that low tax bracket.
And then you just stop right before you hit the higher bracket.
Exactly.
Ah, I see. You are locking in a known 12% or 22% tax rate today to permanently protect that money from the 40.7% tax torpedo tomorrow.
You are draining the dangerous bucket at a massive discount.
That's brilliant. So if I convert $50,000 to a Roth at that 12% rate, can I just withdraw it the next day to buy groceries?
Well, not quite. The IRS saw that loophole coming.
Of course they did.
In Publication 590B, they instituted a strict 5-year rule. Every single amount you convert to a Roth must sit in that account for 5 full tax years before you can withdraw the principal penalty-free.
Assuming you are under age 59 and a half, right?
Yes, and every conversion gets its own independent 5-year clock. If you convert money in 2026, you cannot touch that specific batch of money without penalty until 2031.
Which is why it's called a ladder. You convert a rung of money in year 1 to spend in year 6. You convert a rung in year 2 to spend in year 7.
You're building a pipeline of tax-free money.
But that raises an obvious question. How do you pay for your life during those first 5 years while your Roth conversions are locked in the oven cooking?
This brings us right back to the unsung hero we discussed earlier, the brokerage bucket.
Oh, the bridge.
Exactly. You live off your taxable brokerage account, you sell assets there, pay the vastly lower long-term capital gains rates, and use that principal to buy your groceries.
And because the capital gains rates are so low, that keeps your overall ordinary income low enough to make those Roth conversions incredibly cheap.
Right. It is a beautifully synchronized system when executed correctly.
That makes perfect sense for someone retiring at 60. But what if a listener is already 73? They're already being forced to take those required minimum distributions.
Yeah, the RMDs are already pushing their income up.
Right, threatening the tax torpedo and the IRMAA cliff. Is it too late for them?
It is not too late. The sources highlight another incredibly effective tool for older retirees: qualified charitable distributions, or QCDs.
Okay, what does that do?
A QCD allows you to transfer funds directly from your traditional IRA to a qualified charity. For tax year 2026, the limit is up to $111,000.
So instead of taking the RMD into my own bank account and getting taxed on it, I send it straight to a charity.
Correct. The brilliant part is that the QCD fully satisfies your required minimum distribution for the year, but that money never shows up in your adjusted gross income.
Wow. It just completely bypasses your tax return.
Completely. Because it never hits your HEI,
Yeah.
it mathematically cannot trigger the tax torpedo on your Social Security, and it cannot push you over the IRMAA cliff.
That is a phenomenal tool if you're charitably inclined anyway.
Absolutely.
Wait, if the math is so overwhelmingly in favor of strategically moving money between these buckets for tax efficiency, why did an entire financial industry spend the last 40 years selling people on the bucket strategy as a way to invest their money?
That transition from taxes to investments is where behavioral psychology clashes directly with cold, hard mathematics.
This is the Kitces and Eyes research, right?
Yes. The classic time-segmented bucket strategy was pioneered back in 1985 by Harold Evensky. The idea is that you physically segment your money.
Like keeping a certain amount of cash on hand.
Exactly. You keep years 1 through 5 of your living expenses completely in a safe cash bucket. That way, if the stock market crashes, you don't care. Your next 5 years of groceries are entirely insulated in cash.
I mean, I have to admit, it sounds incredibly logical and safe.
It really does. But the Idaho Business School conducted an exhaustive 115-year study to test this exact strategy. They looked at data across 21 different countries.
115 years, so they've seen everything.
We were talking about testing this through world wars, the Great Depression, stagflation in the 1970s, the 2008 financial crisis.
Wow, and what did they find?
Their conclusion was definitive. The classic time-segmented bucket strategy actually underperforms a simple, static total return portfolio that just automatically rebalances every year.
But wait, let's talk about the cash drag concept. Because right now, sitting here today holding 5 years of cash in a high-yield savings account or a CD can easily earn 4 or 5%.
Yeah.
That doesn't feel like a drag. That feels like a very solid, safe return. Why does this 115-year study say that holding cash ruins my portfolio?
The study looks at the difference between nominal yield and real yield. Yes, you might see a 5% return on your bank statement today, but over a 20 or 30-year retirement, cash fundamentally loses value to inflation.
So even though the number is going up, its buying power is going down.
Exactly. That 5% yield often barely keeps up with the rising cost of goods. By keeping such a huge portion of your portfolio, like 5 full years of expenses, entirely out of the market, you are severely eroding your purchasing power over the decades.
I understand the inflation risk, but what about the market crashes? The whole point of the cash bucket is that it protects you from selling your stocks when they are down.
It absolutely prevents you from selling stocks when they are down. However, the critical flaw is that it also prevents you from buying stocks when they are down.
Okay, let's slow down and unpack this mechanism because this is the real aha moment of the research.
Let's look at a standard total return portfolio, say 60% stocks and 40% bonds.
A classic 60-40 split.
Right. Every year, you take your withdrawal to live on, and then you rebalance your portfolio back to your 60-40 target.
Okay.
If the stock market crashes by 20%, your stock allocation might drop to, say, 50% of your overall portfolio.
Because the stocks lost value, but the bonds held steady.
Exactly. So to get back to your 60% target, you are mechanically forced to sell some of your stable bonds and buy more stocks at rock-bottom prices.
Oh, I see. You are mechanically forcing yourself to buy low and sell high, taking the emotion completely out of it.
Exactly the opposite of what the rigid bucket strategy does.
How does the bucket strategy handle a crash then?
If you use the bucket strategy during a market crash, you just sit there spending down your cash bucket. You are entirely sitting on the sidelines.
You're not buying the dip in the stock market at all.
Nope. You miss the inevitable recovery. Michael Kitces' research points out that by trying to avoid market risk with a huge cash bucket, you inadvertently create a portfolio that just drains itself without ever capitalizing on the massive market rebounds that follow a crash.
But isn't the psychological comfort of a cash bucket worth something?
It's a fair point.
Human beings are emotional creatures, We aren't spreadsheets. It's like keeping a bulky life jacket on while you're sitting safely inside the boat.
Right.
Sure, it's mathematically unnecessary and it slows you down, but it stops you from panic jumping overboard the second the water gets choppy. If holding 5 years of cash prevents a retiree from terrifyingly liquidating their entire stock portfolio at the bottom of a bear market, doesn't it have immense value?
The behavioral benefit is very real. It's a classic example of mental accounting, categorizing money in your head to make it feel safe. And if that psychological comfort is the absolute only thing keeping you invested during a severe economic crisis, then yes, it is worth it.
Bye.
But, as Kitces warns, it creates a false sense of safety. You might feel secure, but you are quietly paying a massive hidden premium for that comfort in the form of lost growth and inflation erosion over 30 years.
So is there a middle ground? Like, can we have the best of both worlds?
The data suggests the most effective approach is a compromise. Use the mathematically superior total return strategy with automatic rebalancing, but perhaps keep a very modest 6 to 12-month cash buffer instead of a massive 5-year bucket.
So you get just enough liquidity to sleep comfortably at night without completely destroying your long-term compound returns.
Precisely. It's about balancing the math with human nature.
So what does this all mean? We have covered a tremendous amount of ground today.
A lot of ground.
You now know that navigating retirement is not just about having enough money. It is about mastering tax diversification. You understand why that flexible, capital gains-friendly brokerage bucket is the ultimate tool to bridge your early retirement years and save you tens of thousands in taxes.
Yep, the bridge is key.
You know the mechanisms behind the 40.7% tax torpedo and the IRMAA cliff, and how to build a Roth conversion ladder or use QCDs to dodge them entirely. And, crucially, we've exposed the mathematical truth behind the behavioral bucket strategy, that protecting your feelings might be costing your portfolio.
Knowledge is only valuable when you actively apply it. The rules of the game fundamentally change the moment you stop working and start withdrawing.
Right. Relying on the exact same strategies that built your wealth will not necessarily protect it during decumulation.
It's a whole new phase of life.
I want to leave you with this final thought to explore on your own. Take a close look at your own retirement accounts today. Are you building your withdrawal strategy for mathematical perfection, or are you building it for psychological comfort?
It's a tough question to answer, honestly.
It is. And more importantly, do you know exactly how much that comfort is secretly costing you in taxes and lost growth? It is your retirement. Make sure you are the one drawing the map.
Well said.
Thank you for joining us on this deep dive. Keep learning, keep optimizing, and we will catch you next time.